Well, thanks so much for tuning into the Trade Setup. I'm Neeraj Shah. Good morning. The key news first. Russia slammed fears about the imminent invasion of Ukraine as baseless. So much as the world is concerned about what will happen between Russia and Ukraine, the protagonist in this case, or the antagonist in the case, or whatever, the key player in this case, however you call it, is slamming these, or is discarding these talks about it looking to invade Ukraine anytime soon. Let's see. The last set of reports that I've read, or the stories that I've read, still suggest that could Wednesday be the detail. Let's wait and watch. Anyways, too much to ponder, don't quite know. German Chancellor Olaf Scholz travels to Kyiv on Monday and meets with Putin in Moscow on Tuesday in another diplomatic push to try and resolve the situation. Let's see. Maybe diplomatic conversations helping. I think US President Joe Biden and Vladimir Putin of Russia did have a hour-long telephone conversation on Saturday as well. Let's wait and watch if all of this bears any fruit. And by the way, while geopolitics is front and center right now, don't forget that the underlying stress on the underlying trends of inflation in the US remain a key monitorable as well. I think this week is important because there's a producer price inflation data from the US on Tuesday and Fed minutes on Wednesday, which could be important releases as well from a market perspective. As I said, much as the market focuses on the very near immediate focus on geopolitics, the underlying focus on inflation trends and what impact they have on market sentiment on that particular day should not be shrugged away. US markets did get spooked by both the inflation print, the Fed minutes, as well as probably geopolitics in Friday. So they came off quite rapidly in Friday's session. If you see the Friday mood, it was very, very wobbly for the US markets. But a key alert, as we speak, the US stock futures, both NASDAQ and the S&P 500 are actually higher in trade. So much as there is fear around the Asian screen, the US futures for now are not doing all that badly, though it could change, right? Because the volumes may be X versus what the actual volumes would be. So wait and watch, but keep an alert that the stock futures are higher when it comes to the US markets. Asia, the Nikkei, the last time I'd seen was down about 2.5%, and it is that way. We have a tick of green almost across all Asian indices and shouldn't be surprised. The key is the SGX Nifty, and let's pull that one up and see what that is indicating in the session today. Just to indicate a sense, just to get a sense of what's the kind of start that we may have. Remember, we also came off a bit in Friday's session, the second half of trade in Friday. India was a very nervous trade. And as we speak, it looks like we'll start off on a very weak footing. The question is, could this get further exaggerated, or could this get bought into? The other problem for Indian markets, viewers, keep in mind, is the fact that oil is on the boil. By whether or not the actual invasion happens or no, if it sends crude prices higher, that's negative for India. I mean, this crisis, of course, helped drive WTI to the highest level since 2014. Like I said, even if it doesn't quite result in an actual war, and God hopes, we hope that it doesn't happen, but oil prices moving up simply is a negative. So that's the trade setup for today. Oil uptick as well as the global nervousness will all play up in the first half of not just today, but for the week, very likely. So I'll be very surprised if there is a major pullback attempt. Sure, from the dips, some uptake here and there could happen. Even that I don't quite know, but I'll be very surprised if we chart, unless some clarity comes around from Russia and oil prices cool off. I'll be very surprised if we actually chart a bit of a comeback. In all probability, the sentiment should be tethered towards the short side or towards the lower end. I would still suggest that it's prudent for people to stay clear of naked leverage longs, or actually naked leverage positions, which are very crucial this week, simply because of the fact that even if you're short, and if there are some statements happen on the geopolitical side which get spread very quickly, it might be very difficult to get a chance to be able to get out of those positions as well. So just be careful if you're trading very large naked positions, both on the short and the long side. Definitely not on the long side, but even on the short side. Stop loss is very important in the scenario. Interpretation may be swift and damaging, right? I mean, whatever statement comes out, the interpretation of that, even if it is not the right interpretation, will be very swift in prices, and therefore stop loss is very, very crucial, viewers. This is my belief per se. I do believe that also in the very near term, if you are fully long equities, and if you want to stay long equities, then commodity stocks, oil, energy, etc., would prove to be hedges for equity investors, which are looking to protect portfolios against this rising geopolitical risk. So if you are parked in that space, it might well still be okay. But ideally, just be careful with leverage in any fashion whatsoever. The small good part is that volatility is not at its peak, and therefore, despite aside of a short spike that we saw, I think 2 days earlier, India VIX is still well behaved, and typically, if VIX is very elevated, that tends to kind of have a bit of a secondary impact as well. That is not the case this time around. Some earnings today, I don't know how much these would matter, but Adani Enterprises and Adani Wilmar, Balkrishna Industries, and again, tire stocks might not have a great day. Coal India, Dhani very actively traded counter the mid cap end. Graphite India, after HEG's strong numbers, maybe this one too could be okay. There could be Natco and IPCA, which could be interesting as well. So a few earnings to monitor, but I don't quite know how much of an impact would earnings have on specific stock. Like, for example, the key stock to watch today, to my mind, is ONGC. So I've been talking about this yesterday and day before, that the oil upstream earnings will be strong. They've been good. They've not been really remarkable, but they've been strong earnings for sure. So look at ONGC, right? Revenues were up 67% at 28,472 crores. The estimates were 28,183. So the revenues were above estimates and 67% higher. EBITDA margins were at 52.2% versus 38.2%. Very strong EBITDA margins, just that they are slightly lower than the Bloomberg estimate of 55.2%. Net profit, big uptake, 8,763 crores, slightly ahead of the Bloomberg estimates of 8,430 crores. You would believe that all of these are great numbers. The stock should react positively. Oil has gone up, the stock should react positively. So in all probability, the Qs should all be positive. But here's the contrast between both some of the brokerages. Either JP Morgan, they've largely been bullish on oil upstream. They've got this call right, to be honest. And their view is that they maintain a buy with the target price of 235. They believe it's a strong operating quarter and should improve given crude and gas price trajectory. It trades as less than 3 times price to earnings on spot, according to JPM. They say that it offers the most attractive risk reward in India energy space, and the implied crude realization for the quarter at 75 per barrel versus spot Brent at 94 per barrel. So there is an upside on crude realizations for the current quarter, this Q4 as well, I reckon, is the implication of what they are trying to say. So they are bullish on that. At the same time, Citi has a sell with target price of 150. They believe 3Q is in line, and there are gains from higher oil prices, but production trends are soft and costs have risen. They believe the miss at the EBITDA level was primarily due to higher OPEX, and they believe that it is very sensitive to crude prices. So if there is a reversal of statements from Russia, Ukraine, and diffusion of tension, and if crude prices cool off, then it could be very negative for ONGC as well. So, like I said, very strong results. You would presume that people would take heart from it, but there are smart analysts out there who are saying that, no, we don't want a piece of ONGC. So let's wait and watch, viewers. I would believe if you have to be in an equity position, fresh one, then maybe oil upstream could be that pocket, simply because of the fact that earnings were strong. By the way, Oil India earnings were pretty strong too, that came out on Friday. So it looks good, but there could be a chink in the armor, one which I can't notice. If you can notice and if you can figure it out, great, good for you. Fortis Healthcare, the numbers looked okay quarter on quarter. And I've just, forget the quarter on quarter piece, I've just compared it versus the estimates. Revenues were at 1467 crores, up 25% versus the Bloomberg estimates of 1433 crores. So marginally higher than estimates, but a 25% growth. Nevertheless, margins at 19.6%. The Bloomberg estimates were 18.4%. Net profit at 117 crores versus the Bloomberg estimate of 99 crores. So all in all, very strong numbers from Fortis Healthcare. I dare say Apollo had a pretty decent quarter too. We'll get to Apollo in a bit when we do the brokerages. Let me first highlight some of the other numbers. So from amongst the ones that stood out for me, I'm not getting you all the numbers, by the way, but Mazagon Dock Shipbuilders revenues were up about 6% at 1.52 crores, but the margins showed a big bump up from 6.3 to 13%, more than double really, and therefore the net profit up 57%. against a 6% revenue uptake, a 57% uptake in net profit. Good numbers on a normal day. I would presume that this stock would have reacted positively. Still good, just that the markets are looking so soft, so you never know. You would argue that the revenue growth of 6% is disappointing, but I think in a quarter wherein most companies are facing margin pressures, any company that actually shows margin resilience should probably be construed positively. So let's wait and watch. Metropolis, though, on the other side, not the best of numbers. Revenues at 293 crores. The Bloomberg estimates were 308 crores. Margins at 25.7. The Bloomberg estimates were 28.6. Net profit at 41 crores. The Bloomberg estimates were 54 crores. So not the best of numbers. I was reading one brokerage note, which actually, which kind of slammed the numbers for Metropolis for sure. Let me just try and quickly get it up for you if I can. It was okay. Sadly, I can't quite find it, but yeah, the Credit Suisse, they have an underperform rating with a target price of 1700, and they are saying that there is an impact of higher competitive intensity now visible on the margins of this one. And despite a 22% downtick in the past 1 month, it still trades at 50 times FY24 P and 30 times FY24 EV EBITDA. So they believe it's expensive, and therefore they are negative on Credit Suisse. They believe it, Metropolis, they believe it will underperform with the target price of 1700. Metropolis, by the way, viewers, is currently at a price of, I think, 2200 or 2250 or thereabouts. So do watch out for this one. Speaking of healthcare and Fortis and Metropolis, Apollo Hospital's numbers were interesting, and I just thought the Kotak view summed it up well, so I thought I'll bring it for you. So they have an ad rating with the target price of 5257. They believe this business has continued the stellar recovery in the hospital's business in third quarter, even as the pharmacy distribution margins fell short of expectations. The company's announced a 2,000-bed expansion across Bengaluru, Mumbai, and Delhi NCR over the next 3 years. They're guiding for the Healthco fundraise in the next 2 or 3 months. A large institutional investor has sold off from Apollo Hospitals. The Amazon deal wasn't quite what the street was hoping for, but maybe the valuations are a bit more favorable. So Kotak has this rating, which is ad. I thought I'll bring up some others as well if I can. Apollo Hospitals, there was a view from Goldman Sachs. They were buy with the target price of 4940. There's CLSA with the target price of 5250, and there's a Citi with the target price of 5800. So most people are sounding constructive on Apollo. Companies that did not get the PLI on the auto side, so Force Motors in the CV space did not get PLI. Electra, JBM Auto, and Greaves Cotton did not get PLI in the EV space. So maybe these companies react negatively. Actually, most companies will by virtue of what the market is doing. But just keep in mind, these might have individual reasons as well. Just a quick list of oil-sensitive viewers, and specifically, like I said, Oil India could be interesting. Interglobe could get impacted negatively, so watch out for that. And the usual thesis is that go out and short some of the paint companies. Keep in mind, Asian Paints has managed the crude uptick until now very well. They've announced price hikes as well, and they have the pricing power. So if you want to go out and trade some of the paint companies, naked shorts, be careful in Asian Paints. That's the point I'm trying to make. Some of the other companies maybe don't have as much of a pricing power as Asian. They might be safer short candidates. So that, and lastly, I think Reliance did some presentations, spoke about the gasification assets, and talked about what is the kind of business that might be, the valuations that are attached to some of these business. Some of the people are saying that the 4 billion valuation, which is about 30,000 odd crores ascribed to the subsidiaries below, is underwhelming and not quite in sync with what most people anticipated. And they believe all this presentation done by Reliance is largely value neutral. I think most of the others too have kind of kept it value neutral, just calling the 30,000 crore valuation of this business as underwhelming, and how they would have expected more. Could it become bigger? Let's wait and watch. But again, oil and gas, energy space, Reliance could well be a stock that could defy some of the weakness, or it could fall maybe less compared to some of the others. So keep that at the back of your mind. Net, we will start off weak. Please be careful if you're trading, and keep in mind that the situation is so volatile that you might want to be safe. I mean, you might want to place the big bets once this very, very choppy, volatile situation is out of the way. So don't be a braveheart right now. Save your capital. It might be put to better use and smarter use in some more days to come, and not necessarily just right now. Thanks so much for tuning in today. Stay safe. If you're stepping out, please stay master.